Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Imagine buying a tiny slice of 500 different companies with a single click. No stock picking, no guesswork, no sleepless nights watching one company's price crash. That is the promise of an ETF, and it has quietly become one of the most powerful tools in modern investing. But what exactly is it? And why do millions of everyday investors trust it to build their wealth? Let's break it down. An ETF stands for Exchange Traded Fund. Think of it as a basket. Instead of buying one single stock, you buy one share of a basket that already holds dozens, hundreds, or even thousands of different assets inside it. That basket might hold stocks, bonds, commodities like gold, or a mix of everything. When you buy one share of an ETF, you instantly own a small piece of everything inside that basket. This is where the magic of diversification comes in. There is an old saying in investing, never put all your eggs in one basket. If you buy shares in a single company and that company struggles, your investment struggles with it. But if you buy an ETF that holds 500 companies, one company having a bad quarter barely moves the needle. The gains from stronger companies can help balance out the weaker ones. Your risk gets spread out instead of concentrated in one place. So how is an ETF different from a mutual fund, which sounds similar? The biggest difference is how they trade. A mutual fund is priced only once a day, after the market closes. An ETF, on the other hand, trades on the stock exchange all day long, just like a regular stock. Its price moves in real time based on supply and demand. You can buy or sell an ETF at 10 in the morning and again at 2 in the afternoon, and the price could be different both times. That flexibility is a major reason ETFs have exploded in popularity over the last 2 decades. There are many types of ETFs to fit different goals. Index ETFs track a broad market benchmark, such as the S&P 500, giving you exposure to 500 of the largest companies in the United States in one purchase. Sector ETFs focus on a single industry, like technology, healthcare, or energy, letting you bet on a specific part of the economy without picking individual winners. Bond ETFs hold a mix of government or corporate debt, often used to balance out the risk of stocks. Commodity ETFs can track gold, oil, or agricultural products. And there are even thematic ETFs built around ideas like clean energy or artificial intelligence. One of the biggest attractions of ETFs is cost. Many ETFs are passively managed, meaning they simply track an existing index rather than paying a team of analysts to pick stocks. That keeps their expense ratios, the annual fee you pay to hold the fund, remarkably low. Over decades, lower fees mean more of your money stays invested and compounds for you instead of being eaten away by management costs. Liquidity is another advantage. Because ETFs trade on major exchanges, they are generally easy to buy and sell during market hours, giving investors flexibility that many other investment vehicles simply cannot match. Of course, ETFs are not risk-free. They still carry market risk, meaning if the overall market or sector drops, the ETF drops too. Some ETFs track their index closely, while others have what is called tracking error, a small gap between the fund's performance and the index it is supposed to follow. And not every ETF is automatically diversified. A sector ETF focused only on one industry can still be volatile if that industry struggles. It is worth checking what is actually inside the basket before you buy. So, who is an ETF good for? Beginners who want broad market exposure without researching individual stocks often start here. Long-term investors building retirement savings appreciate the low costs and steady diversification. Even experienced traders use ETFs to quickly gain or reduce exposure to entire sectors or markets in a single trade. Getting started is simpler than most people expect. You open a brokerage account, search for an ETF that matches your goal, whether that is broad market growth, a specific sector, or income from bonds, and purchase shares just like you would a stock. Many platforms now let you start with a very small amount of money. The bigger idea behind ETFs is this: you do not need to be a stock-picking expert to build wealth over time. A well-chosen ETF can give you instant diversification, low costs, and the flexibility of trading like a stock, all in one simple package. This video is for educational purposes only and is not financial or investment advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If this helped you understand ETFs a little better, hit subscribe for more clear and simple breakdowns of money really works. See you in the next one.